not only actually the direction of the trade, but also what we could have beyond the trade conflict, because we are seeing the US talking of limited the US company making business in China, or even the oversight of the Chinese company listed in the US is now being questioned. So that's really a major point and a big difficulty for the equity market. Now, how we are navigating on that, and we need to take some position, and the position that we are taking is that the probability of some truce is decreasing, and the probability of further escalation is rising. And this is some readings that we are making for political reason and for trying to understand the direction of the market. And I think as well the expectation from investors are quite low when it comes to the trade war, and very few investors are expecting some truce or even some deal by the end of the year. So it means that if we have some positive news and even some truce, because now no prospect of a trade agreement, but even some truce, that's something that would help the equity market, and I think we should position part of the portfolio on some stocks that would benefit from the truce.
You know, looking at the internals that are coming out from some of these economies, and particularly from China, if you had to take a look at the second quarter of 2019, GDP was about 6.2%, which was one of the slowest rate at which it has grown since 1992. How much of this do you think is attributable to the trade wars, and how much of it do you think it's China's own internal problems?
Well, the trade war has some negative effect. Our economists are calculating that so far the trade conflict has removed something like 0.6, 0.8 of GDP in China, and there could be some worsening impact if it really impacts business confidence and investment, which so far is not yet the case. So what we can say is that the impact has been serious so far. Still manageable, because we see that China policymakers, whether on the fiscal side or on the monetary side, they still have ammunition left, and we have some very targeted easing which is taking place, but we have to recognize that the impact is being felt on the economy.
Right. And do you think central banks are doing enough? I mean, we've heard Jerome Powell, there is a possibility of a further rate cut, but obviously, you know, the conversation in Jackson Hole was this is a whole new dynamic environment that we are in currently, and you know, the Fed should not probably be expected to take measures which will counteract the negative impact of the trade war, because that's not the Fed's job. But nonetheless, is there enough monetary stimulus in the system across the world from world central banks?
Well, in the US, our scenario and our house view is that between today and the month of June of 2020, we will have a 6th cut by the Federal Reserve, which are needed to soften some slowdown that we are seeing in the US economy, and we are in the camp of people, of analysts who think that we could have a recession in the US in the second half of 2020. which is not going to be a deep recession, but still we expect 2 quarters of negative growth, and the Fed is acting on this. Now, one of the questions, especially in Asia, which is the region that I look at most, is how is it going to impact the Asian markets? And I think the key is really what's going to happen on the US dollar, because so far we have seen since the end of July that the Fed has started to execute the cuts, but the dollar is still remaining quite strong, and the dollar is remaining strong especially against the Asia ex-Japan currency. And that probably has something to do with the trade war, and if we are seeing some truth in the trade war with the Federal Reserve also continuing to cut interest rate, then we could maybe see some dollar peaking and a more favorable environment for Asia equities.
You look at Asian equities very closely, Frank. So which Asian market currently is your top favorite?
Well, we continue to have some overweight position on China, and so we've been China bull for quite some time, since almost a year, and at the moment, on a relative basis, on the moment, I don't see any reason why I should not continue to be overweight China. This is where we see earnings outperforming the rest of the Asian equity market, and it is also a market which is relatively shielded from what's happening in other markets. So the level of correlation on this market is quite low compared to other major markets in the region. It doesn't mean that we expect 50% upside on the market. That is not the case. We have much more modest upside, but this is the one which is on a risk-reward basis is the most favorable. Taiwan is a market which also is interesting, especially from the beginning of next year, when we see some bottoming of the semiconductor cycle. So these are two of the markets that we would consider at the moment.
All right, and my last question to you, Frank, is with regards to India. Where does India stack up in that list? And do you feel that the current correction that India has seen has brought it down in terms of valuations to stand at par with some of its peers, or it's still looking expensive?
Yes, so well, regarding the valuation, what we observe on the Indian market relative to the other market in the region is the market has always been more expensive, whether you consider it in terms of price earning close to 20 times or in terms of price to book ratio. And there has been a reason why India has been more expensive than the other market, well, because of some of the component of the equity structure of the Indian market, with some services company which tend to have some higher level of valuation, but also because the expectation of growth were quite high. So of course, as an investor, you can accept a higher valuation if you know that the growth of the earnings in the next 3 years is going to be strong. So the price to earnings growth is going to be what matters. But what's happening in India is that, well, even India actually has growth slowing down and increasing question on the strength of the consumption, especially with some the rural consumption, which has been very much under pressure. So that's why we've seen the market in the last 3 months having some very disappointing performance. So I think on a long term, there is no question that that's a very, very exciting market because of the growth prospect. But tactically, well, we could have a period of a pause in this outperformance.